All right, here we are. We're in October already, and it's fall, and other parts of the country, the leaves are changing colors, and it's beautiful out. This month, we're going to jump right into all these numbers. We got some different slides we're going to check out. A couple things that, some new slides as well that kind of just for fun, just to kind of demonstrate some fun stuff. That's about it. Overall, the housing market is moving rather briskly. Sales are happening. The things that are holding us back, we're going to get into as well right here in the beginning in the initial commentary. And, it should be a interesting one. Because this is so long, I do put the time codes into the notes below. You can jump ahead just by clicking if there is a particular topic that interests you and you want to get to right away. That said, also, if you're interested in buying or selling or investing in real estate, please let me know. We would love to reach out and chat with you as our team is beginning to grow. All right, let's jump into it. Okay, so this month we have our housing recovery is continued, and it has experienced a strong V-shaped recovery and is now exceeding pre-pandemic levels. That's Mark Fleming, Chief Economist at First American. How are we gauging all this recovery activity? And this is usually what we look at when we start running into stats, facts, and trying to figure out what's going on. Well, the Housing Market Recovery Index is something put together by Realtor.com. They take the four components of demand, supply, price, and time on market and draw a conclusion on their recovery index. They feel that the housing economy is strong nationwide, and I tend to agree with them. In fact, looking at the key metrics that are necessary, we can see that the showings, purchase applications, pending deals, existing home sales, new home sales, all are doing really fantastic. But there's one caveat. We don't have enough inventory. This is a real problem. So the question becomes, can we keep this up? Well, that's a great question. Consumer spending is really where we start to figure out where we're at as a country as far as growth and what's happening. In the United States, total spending by all consumers as compared to January 1, 2020, so that's the reference point, month over month, we did see the drop off and the fall off in the pandemic. But now things have almost gotten back to pre-pandemic levels. That said, there are specific areas of the country that are doing better than others, and it's going to show itself right here on this next slide. Here we see the change in consumer spending since January 1. And I think it's pretty obvious that the states that are having problems, that are still in lockdown, that are limiting their the amount of business open are the ones that typically are hurting the most right now. And I would also add one caveat. When you look at Hawaii and California, a large part of their income and retail spending is driven by tourism. Well, that's not really happening right now. So that's a big caveat in what is going on, at least we can say with Los Angeles, and Hawaii. Overall, the unemployment numbers for Los Angeles are doing better. We have dropped to 15% unemployment. That's for September, adjusted. It's still better than what it was. We hit almost 20% at the peak. As for the U.S. unemployment rate, we are doing fantastic. We are making great progress into getting back into the normal ranges of unemployment. Nobody likes unemployment, but there is, historical ranges, and we're starting to get back into that range, and that's a great sign overall. It's a little bit easier to see it on this slide. You can see that we've gone from 14.7 nationally to 7.9 in September. That is a fantastic adjustment. It is moving in the right direction. To give you a comparison of what unemployment looked like in previous recessions, This slide is a great demonstration of the overall number of months in which the unemployment rate exceeded 9%. Well, the Great Depression was 108 months. The Great Recession was 30 months. The 1980s oil recession was 19 months. The pandemic, 2020, 4 months. Now, we're not out of it yet, but still, we're making great progress. So things are moving in the right direction overall nationally. Now, for those of you familiar with month's supply of inventory, I talk about it from time to time, but this chart really kind of hammers it home as to what the definitions are according to the National Association of Realtors. Anything more than 7 months is considered a buyer's market. Anything less than 6 months is considered a seller's market. So in between 6 and 7 months is just a normal market. In Los Angeles, that tends to have a different feel to it. I've mentioned this before. Sometimes 3 to 4 months can start to feel like a buyer's market in Los Angeles just because the supply starts to build up and everybody goes, oh, look at all these options. Well, there's also a limited amount of buyers out there who can purchase in certain price ranges. So that does exacerbate the problem quite extensively. But right now, nationally, we are in a seller's market. We talked about low inventory in the slide earlier. That's exactly what's happening right now. We have low inventory. So for those who feel like that we're going to see a lot of forbearances and that's going to flood foreclosure inventory, let me allay your fears right now. It's not going to happen. The number of homes that are active mortgages, that are in active forbearance, is decreasing rapidly. Why? Because they can sell. And they can just sell their property. There's no other simpler explanation. How are they able to do this? Well, most property owners have a substantial amount of equity. As you can see on this slide, this is the percentage of homeowner equity in 2020. Now, when you look at this breakdown, 42% have 100% equity in their home of homeowners in this country. Another 16.6% have 60 to 99% equity in their home. That's huge. So if any of those people are in the categories of the 12.5 and the 15.4, anyone who has a mortgage that's in forbearance right now and is in real trouble, the vast majority of people are going to sell. And that's just because they can. They can sell and take their equity and leave. They don't have to go to foreclosure. It's not necessary for them. As for future home prices, the projections are still fairly strong for this year and the next 12 months. Only one, house.com, is predicting that it's going to be a pullback. I'm not sure which market they're looking at. We can definitely delve into that as well. So as you can see on this slide, the projections for the mortgage rates are going to be staying low into the foreseeable future. Many people feel like the Fed is keeping rates artificially low, but one of the Zoom meetings that I was on recently with Barry Sternlicht, he's a very well-known real estate investor, hotelier in the real estate world. His comment was pretty direct, and he was right in saying so. How can the federal government raise rates? How can the Fed raise rates when Europe is negative? It's really hard to do. So the bond rates across the planet are going to stay low for the foreseeable future, which is part of the reason why we're seeing flows into real estate and the stock market, because bond rates are just so low. There's no other place to go. This is very different from the increase in delinquencies that are following the housing bubble. Lending standards have been fairly solid over the last decade, and most of these homeowners have equity in their homes. And they will be able to restructure their loans once they are employed, if they need to. Since the beginning of the COVID pandemic in March, nearly 400,000 fewer homes have been listed compared to last year. That's leaving a gaping hole in the U.S. housing inventory. As a result, home prices are accelerating at double last year's pace. And that's Realtor.com. So what does all this mean? Well, when we look at the seller traffic index, we can see where the seller traffic is strong. What do we mean? The number of people who are interested in and actually listing their homes for sale. It's very, very strong, very stable in a few states. But for the most part across this country, people are settling in and they're staying right where they are. And that is destroying inventory. So the year-over-year change in listings, we can see that overall the total number of listings is down. This slide's pretty good, but I like this next slide where you can really see the existing homes and the new home sales versus the actual number of listings that have been coming on market. And it's not moving fast enough to keep up pace with the demand for single-family housing. So where are all these people looking to buy? Well, most people are accelerating towards suburban properties versus urban properties. You can see that the acceleration in the price increasing and movement in the number of properties selling has moved drastically. So what does the year-over-year equity gain look like? Well, across the country, for the most part, almost every single state has seen some kind of equity gain from this action and not having enough inventory. So they're seeing some increase in equity. Last, one more quote. Truth is attainable by laying fact upon fact. It's hard to argue the facts. Let's jump into the sales. So for LA County, single-family housing and active listings actually has decreased year over year. As you can see on the chart, we are at extreme lows, down 27% year over year with 9,852 listings active currently. The pending sales also has fallen from down to 3,378. That is a 14.7 decrease year over year in number of sales pending. The number of closed sales has stayed pretty consistent and actually increased this time of year for the month of September year over year by 15% at 4,530. And then this is one of my fun slides in which we actually look at the number of active listings versus the number of closed. And you can see pretty consistent over time that the number of active listings since the beginning of the year has been staying relatively really low, while sales dipped off but then came roaring back. Pretty strong recovery in the sales market. The single-family median sales price gained again. Remember, low inventory, strong demand equals a rise in price. Almost 18.6% year over year to a median sales price of $810,000. It's a huge, huge year over year gain. The single family average price per square foot also increased to $561, a huge jump of 15.9% year over year. And this is one of my fun little new slides. I decided to break out each sector of the home market by price. Fair enough. So you have everything under $1 million on the bottom. You have $1 million to $2 million in the next lineup. You have $2 million to $5 million on the lineup from that. And then the very top line is the luxury market. Now you can see that the luxury market is just going haywire. Like it'll spike up off of one sale and then it'll just completely fall back down again. It's really tough to peg where the luxury market is going. At this moment, it's in the middle of its range as far as average price per square foot. We'll see if it holds. I know that there is a lot of inventory out there. In fact, when I broke out that sector, I don't have the slide up, but it was almost 18 months of inventory. It was ridiculous how much inventory is available out there at this moment in time. So I do expect some price adjustment in the luxury market. But as far as the other markets, the below 5 million, it looks like right now they overall are pretty stable. We did get a dip down into May, but once June, July came out, it's starting to resume its pricing level where it was at before. All of these are pretty stable in about where they sit as far as their pricing. The only one who's seen real significant gains over time is the under $1 million mark. They have consistently seen gains in their price per square foot averages. So that is by far the strongest market right now as well. The month supply for single family houses is at 2.8 months. That is less than a 20% year over year. That means we went down a lot. We do not have enough inventory year over year to sustain the current purchasing level. So if you're thinking about selling, it's a good time if you have a single family house and you want to sell it. It's a good time. You can sell. Single family shadow inventory. This is what I basically do is I take a look at the expired listings, the withdrawn listings, canceled listings, people who were on market, couldn't sell, or pulled their listings off for some reason, be it whether they leased the property or not. This is just kind of like a fun slide to guess how much inventory is out there on top of it, how many months supply. We're figuring about a third of a month is basically out there right now. Roughly 1,500 listings are in LA County, could not, have not sold. That said, this is another one of my fun slides. You guys have recognized this one before. I like to show the number of active listings versus the number of closed sales versus the rise and fall in average price per square foot. As we can see, the number of sales has been consistent for the past couple of months. After the initial lockdown phase, people came back out. They started buying. That's evident in the active sales. The number of listings available has stayed low since last year. We have not seen enough listings come on market to fulfill or satiate everyone's desires. And that has caused the price per square foot to rise rapidly. Now, will it stay like this? Who knows? Right now, it's here. Take advantage of it while you can. Condos. The number of active condo listings is 3,488. That's a 12% increase year over year. The pending sales has fallen by 13% to 753 for condos. But the number of closed sales last month was pretty spectacular at 1,158 closed sales. That's really strong number. That's 25% increase year over year. All that excess demand getting soaked up. The question is, will it continue? We will see. The median sales price rose by almost 5% to $535,000. That also might give you an indication of which sector of the market is performing best. We're going to take a look at that as well. The average price per square foot for condos is $521 per square foot. It did pull back some last month, but it's still a 1% increase year over year. Now, same slide, except with condos. We broke out the troughs a little bit different. So we had under 500,000, 500,000 to 750,000, 750,000 to $1 million, and then over $1 million. This is interesting because under the $500,000 mark is seeing the most gains right now. The 500 to 750,000 is ping-ponging. It's kind of, we're up, we're down, we're up, we're down. But overall, it looks like it's starting to slide a little bit. Hard to say what it's going to do in the future. That can change. As far as the $750,000 to $1 million condo, those seem to be just kind of flatlined. They're holding right now, no real change in where they're at. As far as the $1 million and up in a condo, it's not looking good. They are at the bottom of their range right now, and if it breaks that range, it might be a little bit of a pullback in pricing for the luxury condo market, which $1 million for a condo or $1 million for a house, which one do you want to do? Just saying. The month's supply has increased. It's at 4.2 months supply total for condos. This is a 20% increase year over year. We are seeing supply creep up. It is happening. Leases and for rent. This is another one of my little experiments, just kind of like watch and see what's really going on, but through this whole pandemic. But last slide, here it is, increase of actual number of units available for rent. The largest increase in the number of units for rent, interestingly enough, is in the condo market. Surprise! So if there's more condos putting their places up for lease and more condos on the market, and they're having a harder time filling those, what does that mean? Supply and demand. We'll see, but I have my hunches. Listen, that's the market update for this month. I hope that you enjoyed it. I try to be as educational as I possibly can in this update. It's a long one, and so we try to take a fact-based look at the market and see what's going on. If you have any questions or you want to see something in a future market update, some particular market sector, leave a comment below. I'm happy to entertain that and produce some kind of like fun little slide and take a look at stuff and just see what's out there. Again, my name is Dennis Maynard. I'm a real estate broker in Los Angeles. Thank you so much for watching.